Good morning and welcome to today's webcast, Regulatory Shifts and Implications of the Budget Reconciliation Bill. Before we get started, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you could read more about it on our website via the link in the slide deck and handouts widget. And with that, I'll turn over to John to get us started.
All right. Thank you, Emily. I'm John Donohue, and I'd like to welcome everyone to our webcast today. We have an expert panel assembled for you, but before I introduce them, just a little bit of background. We knew this was going to be an interesting year for all companies, but especially for our public companies, given the change of administration. Back in January, we started early planning for putting this panel together, assuming that there was going to be significant tax reform and major changes in the regulatory environment that would be hot topics for our clients. So with this mid-year check-in is a bit of a recap as to where we are to date and what change we still expect to come. As Emily mentioned, we recently completed our merger with Baker Tilly, so we welcome the Heritage Baker Tilly clients and people in addition to those joining us from the Heritage Moss Adams side as well. All of the panelists today played leading roles in the Heritage Moss Adams Tax and Assurance National Office, and I'm happy to introduce them next. Just real quick, starting with myself, I'm an assurance partner, and I led the SEC practice at Moss Adams prior to the merger with Baker Tilly. My experience includes 2 years as a professional accounting fellow at the Securities and Exchange Commission. Next up, Porter Loud, a principal in the assurance group of our national office, specializing in complex accounting and regulatory matters. Porter recently returned from a 3-year term as a professional accounting fellow in the SEC's Office of the Chief Accountant and is also a participant in the AICPA's Digital Assets Working Group. Next, Dave Antoni, a managing director in the firm's National Tax Office, who led Moss Adams' ASC 740 practice. And prior to joining the firm, Dave had over 35 years with the Big Four firm in Philadelphia. Next up, Andy Cates, who I think looks far too good to have retired in front of his principal title there. But prior to the combination, Andy was the leader of our national office tax technical team with deep expertise in a variety of technical tax matters and really serving our public companies from an ASC 740 perspective. Last and certainly not least, Christopher Hanna, who is a professor of tax law at Southern Methodist University, in addition to being a tenured professor and published author of tax. Christopher has assisted or consulted with multiple joint committees of Congress and served as a senior policy advisor for tax reform to the U.S. Senate Committee on Finance. He also practiced law for a few years as well. So anyway, that is our panel today. We're excited to share the insights we have for you. Again, it's going to be a mix of tax and regulatory updates. We're going to go through both tax, then the SEC update, followed by a little bit more on taxes. And again, our overall purpose today is to give you an update on the substantive kind of regulatory changes. This is focused on public companies and C Corps. So I'd say if you're not a public company, but you're still a C Corp, there's going to be a lot of good information here that's applicable. And so we hope you will enjoy it. Starting first up, Christopher, I'll turn it over to you to talk about the One Big Beautiful Bill Act.
Sure. Thank you, John. One thing I was just going to, since you mentioned the public companies, John, one of the things that I was working with the Senate Finance Committee, I would always take an informal poll as the companies would come in and talk to us about tax legislation. And of the public companies, I would always ask them which is king, P&L or cash. And the responses typically were about 75% would say P&L was king there, and then 25% would say cash. And then, of course, with your non-publicly traded companies, cash, 100% cash was king there. So I just always thought it was kind of interesting there. So I thought I'd just take a minute or two, just talk a little bit about the One Big Beautiful Bill Act, or OB3, as some like to refer to it now. So what was, I think, a very interesting part of the process there was that they pretty much stayed on timeline throughout the process there. So early on in the process, in order to get this bill enacted there, two things have to happen there. The House and the Senate have to agree on a budget resolution, which we refer to as a concurrent budget resolution, and they have to pass the identical budget resolution. And so early on, there was a thinking that that was going to be extremely difficult to accomplish there, and they were able to do it. And then so that unlocks the budget reconciliation process there. And of course, the key to the budget reconciliation process is really in the Senate there, where most legislation in the Senate requires 60 votes to get enacted because of the filibuster and overcoming the filibuster in the Senate there. But if you do it through the budget reconciliation process there, you can enact the legislation in the Senate with a simple majority of 51 votes for the legislation. So they stayed in the timeline throughout the entire process. Speaker of the House, Mike Johnson, was setting up these dates there, and there was a lot of question. Now, there's just no way they can meet that date there, and they consistently met those dates there, and it culminated in a July 4th signing of the One Big Beautiful Bill Act there. Most of us view it primarily as an extenders bill. So you had a number of provisions of the Tax Cuts and Jobs Act of 2017 that were expiring at the end of this year, 2025. And most of those provisions were on the individual side as opposed to the corporate side. And that was done for a reason, to pick the individual ones that were expiring there. So it extended those permanently for the most part, and generally scaling back the energy credits there, and also a temporary enactment of the campaign proposals, President Trump's campaign proposals there, no tax on tips, no tax on overtime, relieving taxation of Social Security benefits, deduction of interest expense for new U.S.-made automobiles there. Those provisions were enacted as part of the OB3, but on a temporary basis there, generally from 2025 through 2028 there. Two very opposing views of the legislation. Well, it'll be interesting to see over time, as we view this piece of legislation. One, that it increases deficits by $3.4 trillion over the budget period there. It's generally a 10-year budget period that we look at there. So it increases deficits by almost $3.5 trillion, and that's not counting the additional interest on the debt. And the other is that it prevented a large tax increase on individuals there. The Senate utilized a current policy baseline with respect to this particular piece of legislation. And I think that will be one of the legacies of this piece of legislation there, and maybe a precedent for future pieces of legislation. This alternative baseline that they adopted, known as the current policy baseline. And so they view it as actually decreasing the deficit by $366 billion there. And so it'll be interesting to see as we move forward there, now that they've done this. And it's not like it hasn't ever been done in the past, but at this scale being done there, whether this will become utilized in the future with respect to legislation they're adopting this current policy baseline.
That was going to be one of my questions, Christopher,
Sure.
is have they done that in the past? I couldn't recall. And what you're saying is yes, but not for billion-dollar bills?
Yes. Basically, this was a huge issue back around 2012. Then the Bush tax cuts were expiring at the end of 2012, right? And that led to ATRA, American Taxpayer Reform Act, which was signed in early 2013, ATRA. And there, the Obama administration was actually adopting a current policy baseline and arguing for a current policy baseline. The administration was, but the Congress was using a current law baseline there back in 2012 there. And so there were different views on that, on ATRA, that particular piece of legislation, what impact that it had with respect to deficits there. And so when it came up again here more recently this year, I was like, wow, that's kind of a replay of 2012 there, where we got into this discussion of current law versus a current policy baseline there. The House is discussing a second budget reconciliation bill, or tax extenders bill later this year. You could do a budget reconciliation bill each government fiscal year, which runs from October 1 to September 30th. So again, to unlock that process there, the House and the Senate would both have to pass identical budget resolutions. They'd have to do that first. Once they do that, then that will then unlock the budget reconciliation process there, where they could do another bill during this upcoming government fiscal year there. The Senate, at least what's being reported, is not entirely on board of this at the moment there. I can tell you there was discussion of this after enactment of the Tax Cuts and Jobs Act of 2017 about doing another one. And at least in the Senate, there was kind of a fatigue. It's like, look, we just did this. Why would we want to come back to this? And one of the things is tax legislation in the Senate Finance Committee has responsibility for tax legislation there. And it has jurisdiction over a lot of matters there, including trade and health and oversight. And what sometimes people don't entirely understand is the members of the Senate Finance Committee, there's usually only a handful of them that are really interested in tax. And so the idea of kind of revisiting this after we just did this there is kind of like, we just did this. Let's move on to some other things here. So it'll be interesting to see here, but the House is certainly discussing that. Doing another bill here, whether it's a second budget reconciliation bill, a tax extenders bill later this year.
So Christopher, speaking of moving on, I believe that brings us to our first polling question here. So for the audience, we've got our first one. Please get your votes in. I know, Christopher, one thing we were talking about kind of before the webinar today is there's some fun tax trivia around how these tax bills are named, right? So whether or not kind of OB3 is really the name of it, or just what we're all calling it there.
Okay, sure. In fact, when I refer to ATRA, I should have referred to American Taxpayer Relief Act of 2012. I think I may have said tax reform. American Taxpayer Relief Act of 2012, where that issue of current law versus current policy came into discussion. The One Big Beautiful Bill Act was signed into law. Okay, so the question, January 1, April 1, July 4th, or hasn't been signed into law yet. As to the title here, that is not the official title. All right, so that was stricken very, very late in the process there. Senate Minority Leader Chuck Schumer raised a point of order against the title there, requesting that it be stricken from the piece of legislation, which it immediately was. And so this is something that we've seen here in recent times there. The Tax Cuts and Jobs Act of 2017, that is not the official title of it there. That title was stricken, and this is something that both parties have been doing. When you enact legislation through the budget reconciliation process there, you have to comply with what's known as the Berg rule. And there are different aspects associated with the Berg rule there. And one of those is that a provision has to have a revenue impact. A title does not have a revenue impact there, right? And so therefore, a point of order is raised against the title there, all right? The Democrats did this against the Republicans, the Tax Cuts of Jobs Act of 2017, stricken the title there. The Republicans responded in kind with the Inflation Reduction Act there of 2022. And now the Democrats responding again here with the One Big Beautiful Bill Act, stricken from the title there. So that is not the official title of it there, but it is what everybody refers to it at. It's the same thing with the CJA, the Tax Cuts of Jobs.
Christopher, I think that's one thing where the mechanics of the legislative process are kind of beyond us, kind of normal Americans sometimes in terms of that process. But I think we gave enough time. 92% of our attendees have responded to this first poll, so we're going to close it. Most everyone got that right at 69% being July 4th, and that's going to be important for us later on when we talk about ASC 740 and the financial reporting implications of this new bill. So Christopher, back to you.
Okay, so we've had a number of presidential orders, whether executive orders or memoranda, impacting Treasury regulations, such as repealing 10 regulations for each one, or identifying 10 regulations, I think is what the language said, identifying 10 regulations for repeal for each one enacted there. We're seeing the memorandum discussing Loper-Bright decision, Supreme Court decision on Loper-Bright, which, as a very general rule, Dave Antoni, who's an expert on this, he might be able to comment on this here, which generally the Supreme Court decision kind of repealing Chevron deference with respect to regulations there. It basically, and again, I'm summarizing here, saying there has to be going for the best interpretation. Is what's needed there. And so the impact of Loper-Bright on the issuance of new regulations and repeal of existing regulations. We've seen some of the regulations and rules issued by the Biden administration on the partnership basis shifting transactions there, several pieces of guidance. One is still there, but eliminating several pieces of guidance there with respect to the partnership basis shifting transaction, withdrawing proposed regulations on applying CAMT to partnerships and partners there. And just yesterday, I noticed withdrawing disregarded payment loss rules regulations there. That came out just yesterday. Dave, I don't know if you wanted to kind of comment there with respect to Loper-Bright.
Yeah, I think Loper-Bright was kind of a turning the world upside down in terms of the Supreme Court's decision overturning Chevron, which held basically everything on regulatory issues since 1984. So, basically 40 years later, it gets overturned, and Chief Justice Roberts basically says, as you mentioned, that it's not the regulator that makes the final decision on the interpretation of the statute, it's the courts, and it's the best reading of the statute. And so we're starting to see a lot of activity. The president had his executive order in February of this year. And since then, all the departments have been looking at their regs to determine, are there regs that should be withdrawn? And with respect to Loper-Bright, are they unlawful or are they not the best reading of the statute? And so we're starting to see a lot of activity in this area, and a lot of commentators from practitioners arguing over which regulation should be withdrawn.
Dave, Mike Schlier, a very prominent practitioner who's now retired at Cravath, has been kind of writing on this, and he's been saying he believes that it should cut both ways, that it's not just regulations that are kind of anti-taxpayer regulations there that should be challenged under Loper-Bright is not the best interpretation, but also maybe pro-taxpayer regulations there should also be examined there under the kind of a Loper-Bright standard there, and is that the best interpretation of the statute there? Any thoughts on that? Whether it should cut both ways like that?
I agree with you, Christopher. If you read the opinion in Loper-Bright, Chief Justice Roberts wasn't really coming down on either side. It was basically what is the best reading of the statute, and depending on the administration that is in power at the time, one might be more pro a constituency versus, more protecting the fisc. And so it works both ways, where there could be a pro-taxpayer regulation that was offered, but it maybe went beyond the plain reading of the statute. And so it's possible that favorable regs could be also withdrawn under this type of analysis. We're in a brand new world.
Yeah. And I think the takeaway for our public companies, right, is to understand the basis of your decisions you've made, right, in these regulatory areas and the interpretations, and understand if there's potential risk for those interpretations to be rescinded or otherwise, rethought under some of these new doctrines there and kind of what we've relied on in the past. And this extends far beyond just IRS and taxes, but a wide range of government regulations. All right, Christopher, back to you.
The Deputy Treasury Secretary Falkender, who is a finance professor at the University of Maryland, currently the Deputy Treasury Secretary, has indicated that priority for guidance on the various Trump tax proposals there, such as no tax on tips or no tax on overtime, that those new proposals like that, which are temporary, would receive some priority there in terms of guidance from Treasury. The Honorable Billy Long has resigned as IRS commissioner there for about 2 months, has been replaced on an acting basis by Treasury Secretary Scott Bessent. Secretary Bessent is the 7th head of the IRS this year and the 6th during Trump's second term. We're seeing quite a bit of movement, I guess, at the key Treasury and IRS positions there. Last month, the IRS acting chief counsel, Andrew DeMello, was, I don't know if you want to call it removed, withdrew from that position there last month there. And Ken Keyes, who is the Assistant Secretary of the Treasury for Tax Policy, was put in as the acting IRS chief counsel there. And we're seeing a lot of other positions there at Treasury and IRS, kind of some movement there. I think, Dave, you had one that you wanted to maybe mention.
There was a recent addition to the international council, I believe, that just came in. It's going to be important for the implementation of the international regulations.
All right, so some of the things in OB3, it made permanent 3 provisions that were kind of phased out beginning in 2022, 2023 there, restored 100% expensing for basically tangible, depreciable property with a recovery period of 20 years or less, basically talking about equipment, machinery, things of that nature there. It's a lot broader than that. Restored 100% expensing for domestic R&E expenditures there, not foreign. So foreign still 15-year capitalized and then amortized over a 15-year period there. Domestic was capitalized and amortized over 5 years. Now it's been restored back to 100% expensing for domestic R&E expenditures, and restored the EBITDA base for business interest expense deduction there. Generally, deduct your business interest expense to the extent of 30% of the EBITDA base there. And when that was enacted in 2017, I helped kind of worked on that provision there, working with the Senate Finance Committee. Had an unlimited carry forward period for the disallowed business interest expense there. And the thinking was we had an unlimited carry forward period there that companies wouldn't have to put up any kind of a valuation allowance there against that because it was unlimited like that. And that was done on purpose. And at least it's been reported there, and I know of at least one company that did put up a valuation allowance there against that business interest expense that was being carried forward there against the deferred tax asset there.
Christopher, it really is facts intensive in terms of how much income the company is generating, because the limitation each year is 30% of adjusted taxable income. And so if a company is making losses or they have a lot of interest expense beyond their current taxable income at 30%, you're going to build up a limitation. And although it's unlimited, then you get into scheduling and forecasting future income. And if you're not showing utilization, it does cause a valuation allowance. And that's one item we're going to talk about later in the presentation.
Okay. And the last thing I want to just kind of mention here, which I thought was kind of interesting, just kind of an observation here, is when 163J was enacted there as part of the Tax Cuts and Jobs Act of 2017 there was an issue with respect to, say, depreciation that was capitalized into cost of goods sold, okay, into inventory there. Could you add back that depreciation, which was not a deduction anymore if it was capitalized on the cost of goods sold, which is not a deduction? Could you add that back in determining your EBITDA base, all right? And of course, the companies were saying, yes, we want to be able to add that back there to increase the EBITDA base there to get our business interest expense deduction there. The proposed regs Treasury first came out with said, no, you can't. No, you can't. That is not a deduction. That depreciation that's capitalized into inventory, cost of goods sold, and cost of goods sold is not a deduction. And so, no, you can't. And there was a lot of discussions with Treasury that companies were having to try and change that from the proposed regs. And when Treasury issued final regulations there, they did a 180 on that. They changed that there and says, yes, you can. All right, based upon congressional intent and the language of the statute, and they focused on the word allowable. They said that depreciation is allowable as a deduction, even if it was capitalized into inventory there. And so therefore, I wonder when Treasury did that in the final regulation, saying, okay, this is going to only impact for a few years here. It doesn't matter anymore because it's going to an EBITDA base. Now it's going to matter again, all right? It's going to matter again with the EBITDA base that's been restored here. Temporary expensing for U.S. factories. I think that's kind of viewed as a surrogate for the president's campaign proposal of 15% tax rate for domestic manufacturing income. So I wanted to give some sort of preference to that domestic manufacturing income, did it in the way of allowing a temporary expensing for U.S. factories. Here's something that I was hoping to try and maybe make an observation there, but maybe that I haven't seen too much yet, is the business tax base seems to have been shifted here from primarily an income tax base to a cash flow type of tax base. And this is consistent with the House Republicans' June 2016 tax reform proposal. So when the House Republicans came out with that proposal in June of 2016, nobody paid much attention to it then until after Trump won the election in November of 2016. Then there was a huge amount of focus in that where a number of companies were in favor of this type of proposal there, kind of a cash flow type of tax base there. And there are a number of other companies that came in who are adamantly opposed to that type of proposal there, shifting the base like that. And so the idea is that land, buildings, and inventory other than U.S. factories must still be capitalized. So therefore, it's not completely a cash flow type of tax base, but it has moved very much in that direction by allowing expensing of equipment there, allowing, at least temporarily for U.S. factories like that, allowing expense of domestic research and development, which is thought to lead to the development of intangible assets there. So in essence, you're also expensing your intangible assets there. And so for businesses, and I put this in here, maybe primarily smaller and medium-sized businesses, which don't engage in land and building acquisitions, which still must be capitalized, can't just expense that, and their inventory turns over on at least an annual basis there. So if their inventory is turning over on at least an annual basis there, they're in essence writing off the cost of the inventory there. Then the cash flow tax base is really what they're looking at right now, and it is a type of consumption tax. And that cash flow tax base is getting very, very similar to a type of value-added tax, what's known as a subtraction method value-added tax. And there are consequences to that in terms of moving the base from an income tax base to a consumption tax base there, such as very close to a value-added tax type of base there.
Yep, that's a great observation, Christopher. I guess maybe while we get the next polling question up, Andy, any thoughts on that or any contrary or affirmative views?
Yeah, no, you're right. The cash flow changes significantly, but the other thing that's going to change, and we saw this years ago, is that all of a sudden the deferred taxes on the balance sheets of companies are going to grow. You're going to take all those front-loaded cash flow impacts to the taxes. You're going to build differences more dramatically between the GAAP statements and what's the tax basis, essentially. And because it's bigger, any shifts in rates are going to have a profound impact on the effective tax rate and the P&L. So, for example, if this administration shifts to, a new group down the road here, and they decide that a 21% rate is too low because we need revenues, and they increase it, that's an immediate impact on the effective tax rates for companies. And so we've seen that surprise in the past. I wouldn't doubt that we're setting the stage for one in the future.
Especially where you're building deferred tax liabilities with the 100% expensing.
That's exactly the issue. Yeah, for sure.
Oh, that's helpful, Andy. Thank you. I think it's good perspective, and I think it is a good reminder for folks that when you do get a change of administration, you have a change in rate, the impact running through your effective tax rate as those, deferred tax assets and liabilities are revalued can be significant, and something to sort of think about as you kind of look at your balance sheet and sort of manage that over time. We've got 87% of our attendees have answered the poll, so we're going to go ahead and close it. Any final people who want to get their votes in, please do so. It looks like we've got most folks saying all of the above. 64.6% is the leading answer there. And Christopher, I believe this is correct. So, tell me otherwise if you believe otherwise. But
no, I think that's the best answer. But I think if you picked any of those ones, you're right. 100% expensing is allowed for equipment there. So I think all the answers are correct. But I would agree that all the above is the best answer.
All right. So we're all winners is what you're saying, Christopher. I love that.
That's right.
We're going to take a break from tax for a minute, and I'm going to turn it over to Porter. Porter, you want to talk about maybe some current events with the PCAOB and the SEC?
Yeah, John, thanks a lot. Yeah, happy to pivot over to the accounting and auditing side of the house, which is where I live. So to start, we're going to go through just sharing some of the things that have been happening at the PCAOB as well as the SEC. And an interesting aspect of OB3 is that it included some provisions that would have eliminated the PCAOB as an organization and shifted all of their roles and responsibilities over to the SEC directly. And you might think, well, that's kind of a funny thing to include in a budget reconciliation bill. And some other folks agreed. And those provisions were ultimately eliminated due to the Berg rule that was mentioned earlier. But I think, the reason we bring that up is because it's interesting, but I think it's also reflective of kind of the tone and the environment that the PCAOB is working in right now, and kind of where they've come from and where they've gone. And so kind of zooming out just to level set, the PCAOB is the entity that oversees auditors and their work. And there's really two main ways that they do that. And that's through the inspection process where they, go to firms and inspect their work papers. And they also issue new rules and standards that auditors have to follow, right? And over the last 4 years, kind of prior to President Trump taking office during the previous administration, the PCAOB took a pretty heavy-handed approach towards their role, meaning they were very critical of all audit firms and their inspection process, and also issued not only a high volume of new rules, but also some relatively controversial rules. One of which was no-CLAR, that you may have seen in the headlines. And so anyway, all of this put together just created a very negative reaction from a lot of stakeholders in the ecosystem. There was a lot of pushback on what the PCAOB was doing and just kind of their overall approach to fulfilling their mission. And so kind of the fallout of that we've seen is that earlier in July, the former chair, Erica Williams, resigned. And the new chairman of the SEC, Chairman Atkins, issued a statement listing new candidates for all of the board positions. And so this was probably not unexpected, is what I would say. I think if you look back at the last several presidential administration changes, those usually correspond with changes in both the chair of the PCAOB as well as the majority, if not all, of the board members shortly following. So a lot of folks saw this coming, but where we sit right now, I guess in the timeline of these changes, is that the chair is gone. The existing board members have kind of been put on notice a little bit. And I think what most folks would expect is that the tone and the approach of the PCAOB over the next 3 or 4 years is going to be a little bit lighter, a little bit more collaborative, and a little bit less of a kind of a battle mentality between the regulator and the audit firms, and just a little bit more symbiotic of a relationship. They're of course still going to fulfill their mission and do their jobs, but the tone and the priorities are certainly shifting, and we'll see that pendulum swing.
Porter, maybe just 1 or 2 things to add. I think one is that, I think it's going to take a little while to see some of the PCAOB changes happen. I think the SEC, was slower to make this process happen than maybe some previous administrations. So there's a little time there still to work through the system.
Agreed.
And then I think from a regulatory perspective, I mean, the reality is the SEC doesn't issue a lot of guidance on, internal control and books and records and other sort of matters anymore to companies directly. The PCAOB has really become the tool to help drive, the change in performance the SEC wants to see. So even though a lot of these topics maybe are coming out through the PCAOB and, they're in turn regulating the auditors, it really has been I'd say, consistent mindset between the SEC and the PCAOB as to kind of the type of performance they're looking to drive for both public companies and their auditors. So I think that's why, for a webcast, targeted at public companies, why do we talk about the PCAOB? Well, it's just that regulatory environment and sort of that role and sort of symbiotic relationship between the PCAOB and SEC that has an effect on auditors directly, but an indirect on companies, in an increasing way, particularly the last 4 or 5 years. So,
yep, certainly, definitely agree, John. All right, well, shifting over to the SEC, I think there's going to be a common theme here, which is that, under the prior administration, there was a very, aggressive approach towards regulation, kind of a perception under the former Chair Gensler at the SEC of regulating through enforcement and maybe pursuing big rulemakings and big projects that perhaps were politically motivated and there's differing views on the cost benefit of what was going on at the SEC, right? And so much similar to the PCAOB, whenever there's a change in presidential administration, the chairman of the SEC is appointed by the president. And so there's usually a shift there. And we saw Chairman Atkins get sworn in earlier this spring in April. And he is going to have a far different view of how to run the SEC from what Chair Gensler had. Chair Gensler had a business background, but was also like an academic by trade. And Chairman Atkins is a former commissioner. He has a deep history at the SEC and really takes a more business first approach, I think, in his decision making. If you read his speeches or look at the sentiment of the actions they put out so far. And so as we talked about for the PCAOB, as we look at that pendulum and where the pendulum is swinging, we're definitely in the midst of the pendulum swinging from, kind of a heavy-handed regulator to more swinging back to the other side of a emphasis on collaboration. And as far as the SEC's mission goes, swinging from like an investor protection mindset and focusing solely on investor protection or primarily on that prong of the mission over to capital formation and thinking about, hey, what are things that the SEC can do that are going to be more business friendly in general, right? We say on the slide, it's a new day at the SEC. I think that's a quote from the new chairman, but that's kind of been the theme, right? Like the old regime is gone and this is a new day. One of the things that we'll talk about a little bit is the emphasis that he has communicated on embracing innovation. And that has a lot to do directly with crypto, which is a very political topic at the SEC. But I think also speaks more broadly to, hey, if there's innovative businesses or innovative transactions, like the SEC going forward isn't there to stop companies from innovating or stop companies from taking on transactions that might be outside of the traditional lane or outside of the most conservative lane, but they want to embrace that innovation and, again, help those companies facilitate capital formation. A couple other things I want to mention is that anytime there's a change in the chairman, there's also typically changes in the other leadership roles at the SEC. And so two of a couple of them that might be relevant to the audience is the chief accountant. And so the chief accountant's in charge of interpreting accounting policies and just interpreting accounting and auditing matters on behalf of the SEC. And then the director of the Division of Corporation Finance, that's probably the division that most companies might be familiar with, that they might interact with more frequently than others. That's the group that's in charge of reviewing filings. And so anytime you're working with the SEC, as long as you're not in enforcement, it might usually be with the Division of Corporation Finance. And I think those two leadership changes, again, are important because the policy changes at the top are going to trickle down through those folks as well, right? Each of those offices and divisions are going to similarly interpret existing laws or existing staff positions in new ways, or at least in ways that are probably a little bit of a lighter touch and going to take more of an easy way for companies to move through the SEC process. Now, John, you have anything to add there?
Not really. I mean, I think we'll eventually see a full-time, Division of Corporation Finance leader there, and a lot of the interpretive things around whether executive comp or CD&Is, and I know you've got more on that in a second, Porter. All that runs through the Division of Corporation Finance. So I do think there is a strong policy-making impact, to companies in the disclosure regime and everything, as a result of that office. So yeah, excited to see what's coming.
Yeah, agree. And so we've got a slide here dedicated to crypto, and recognize that for a lot of companies that don't have crypto assets and don't have any interest in crypto assets, this might seem like a niche topic, but in this environment, I think we couldn't talk about the SEC and the changes there without at least mentioning some of what's going on in crypto, because it's been such a focus of the new administration. And kind of similarly, again, to what we talked about with the PCAOB, a lot of that is a reaction to the SEC's approach to crypto prior to this administration, which was, again, very heavy-handed. A lot of entities that were involved in crypto transactions that maybe wanted to go public were facing challenges going through that process. And the SEC primarily had there was a lot of ambiguity around how to apply the securities laws to different crypto assets. So anyway, moving forward, the chair has created a Project Crypto that's led by the Crypto Task Force. And the real goal of this whole thing, if I zoom out, is they're going to bring clarity to how they're going to regulate crypto from the SEC's perspective, right? And that has to do with, the application of the securities laws and making sure everyone knows how that's going to be applied, and so that they can play in the sandbox nicely. But I think more broadly, there was a lot of criticism of the last administration that kind of the harsh approach they were taking towards regulating crypto in this space was pushing a lot of this activity offshore, or not allowing these companies to thrive domestically. And so I think as a matter of policy, there is an aspect of this Project Crypto that's trying to encourage the United States, and our economy to be able to have these businesses thrive and have the technology thrive in whatever way that it grows organically. But I think they want to bring that business back into America and not push people out of our capital markets. All right, and last item we wanted to cover is just kind of a little potpourri of things that have happened at the SEC since these changes in administration. All of these are, again, going to be consistent with a theme of kind of a little bit of removing regulation and making things easier for companies to move through the SEC's process. The biggest one I wanted to talk about was the climate rule. That was a very controversial rule that the prior administration undertook that ultimately went through litigation. And the SEC, subsequent to the administration change, voted to end their defense of the climate-related disclosure rules. So those rules would have required companies to include a lot more information in their filings about different climate metrics and what they do in the climate space. And there was a lot of political tension on this rule, but again, it's been removed. 14 other rules were also removed earlier this year. And John, as you mentioned, there's a roundtable was held to kind of reassess the cost benefit of executive compensation disclosures and rethink about where those should go. I don't think that executive comp disclosures aren't going to go away, but there certainly could be a rethink about what information is most beneficial for investors and what information needs to be included.
Yeah. How many pages do you really need on executive comp, right, to achieve your policy objective, and how much does each page cost? I think that is some of the mindset here.
Cool. Well, as we move forward, I think there's going to continue to be changes, but again, they're going to be on that theme of removing some regulation and removing those barriers for companies that are trying to file or do other transactions with the SEC.
Yep. No, thank you, Porter. And I just threw up the third polling question, so please, participants, get your CPE. Let's get the polls answered. I do think, again, we're not going to get too far into ESG. I think it is just good for companies to also realize California still has their ESG disclosure regime, and those rules are still in place, and there's been some movement there, but again, those have not been repealed. And then I know Europe was taking a second look at some of their CSRD frameworks as well, because they were going to have a fairly robust ESG related regulatory regime that was going to catch a lot of U.S. multinational companies kind of in its web as well. All right, we've got 67% of our attendees. We can get those last 50 or so here. It would be great to get the poll closed, but go for it, Dave.
John. Yeah, one final comment on the SEC from a tax viewpoint. We noticed recently that in the House Appropriations Committee, Chair Tom Kroll put out a statement at the end of July that there are a number of Republicans on that committee have their eye on the FASB and what the FASB is doing with the current income tax disclosure rules that are effective for public companies this year. And they basically put language into the committee markup coming out of the House Appropriations Committee that the SEC funding must include a directive that FASB's budget should not be approved until they withdraw ASU 2309, the new expanded income tax disclosure. So it's going to be interesting to see if that really moves forward, when the appropriations bill is finally approved.
I agree, Dave, and I think we've had mixed results in the past when Congress gets involved in accounting standard setting. Most recently in the CARES Act, I think before this, and some of the post-COVID banking requirements. But yeah, it'll be interesting to see where that goes, particularly how close we are to adoption. Usually when you're this far along in the process and a standard like that, a lot of the cost has already been incurred gathering the information and doing the work. So be curious to see where that plays out. But all right, I'm going to turn it back over to Dave and Andy and Christopher to talk a little bit more about OBA and ASC 740.
Sure, thanks, John. All right, so I'm actually going to do this rather quickly here, although I know Andy may have a comment or two on this, maybe Dave. So it's interesting here with the expensing that OB3 provides here. Does that give rise to kind of, if you want to call it corporate tax shelters, or maybe more accurately kind of corporate tax arbitrage opportunities here? And the underlying principle here that I think needs to be understood is that if you can expense an asset or an investment, that is a zero effective tax rate on the income generated by that asset. Right. So when people talk about expensing versus accelerated depreciation or straight line, they're like, well, it's just timing. That's all that is. And while it's true, that expensing does lead to a zero effective tax rate on the income generated by the asset. That is equivalent to just not taxing the income that the asset generates there. Effectively, it's taxed at zero. If you couple that with debt financing for that expensed asset, that leads to a negative effective tax rate with respect to that asset there, the income of that particular asset there. And this is something we've been discussing kind of internally here. I haven't seen any discussion of this until last week. Last week, the Congressional Research Service issued a document Thursday of last week, co-authored by Dr. Jane Gravel, and she's a very, very knowledgeable tax scholar. And she has now raised this, saying what we're looking at now is debt financing for assets that can be expensed there, which is a lot of assets now. That leads to a negative effective tax rate associated with that particular asset. What kind of planning opportunities are now available associated with that?
Yeah, no, that's great, Christopher. And again, not to interrupt you, but I threw up our last polling question there just so folks can get their CPE right around that 15-minute mark. But yeah, agree. It's an interesting way to think about it. I think most of us non-tax accountants don't necessarily think about kind of the immediate expensing of equipment like that with quite that perspective.
And there's probably a reason for that. Is the effective rate, when we talk the financial statements, accelerating those deductions and allowing, it doesn't change the reported effective rate because it does create the timing difference. But when you think about the motivation to use leverage to get capital assets and then expense all of them, including the interest, that is an absolute impact. And that's what Christopher is referring to. And so you get this behavioral shift. And while some of it was actually intended for the law change, because they want people out there boosting businesses and, juicing the activity, you've got to be thinking about what happens at the back end. And that's my comments earlier. So they're tied together.
Well, Andy, speaking of juice and activity, I need 50 more people to juice our polling question here so they get the CPE they need.
This is our last polling question.
Last polling question, right. While we're waiting for them, Christopher, do you want to talk a little bit about international? I mean, I know that's been a huge topic recently because we've had, the Pillar 2 stuff, and there was talk about the revenge tax, and it's been, maybe simple and complicated all at the same time. So I'm going to give about 30 more seconds on the poll, but do you want to cover international while we're waiting?
Sure. So as part of OB3, the House bill really had not much on international tax at all, which was a surprise to many, except it did have the proposed Section 899, the so-called revenge tax, and had their kind of version of that in there. The revenge tax was eventually dropped in the final piece of the legislation there, where basically Treasury Secretary Bissett said they had an agreement with the G7 countries there, where they wouldn't impose kind of the OECD Pillar 2, basically IIR and the UTPR against U.S. multinationals there. And so kind of the view was there really wasn't a need for this so-called revenge tax there. The OECD has a 30-page document there, draft document there, kind of following up on the G7's actions there associated with kind of these Pillar 2 taxes there with respect to U.S. multinationals there. But the Senate did have a number of changes to the U.S. Proposed changes to the U.S. international tax system, which were enacted into the law there. Some of these changes seem to be very, very, I think were good changes, right? So good things that were done there. So, for example, the 20% haircut on foreign tax credits associated with GILTI, they reduced the 20% haircut where you just lost 20% of your foreign tax credits to 10%. I think that was a good thing. That was a good thing that they did there. One thing that I wanted to say is they very subtly changed the U.S. international tax system, though, with their changes. The idea, what was enacted in TCJA, was to try and tax categorically, specifically, supernormal or excess profits. And the idea is that excess profits equals intangible income. So you have to get that into your mindset there. Excess profits and tangible income are interchangeable, right? And that was the idea behind TCJA. But here, with some of the very subtle changes that the Senate made here, now they're saying, no, we're not looking at excess profits or intangible incomes. We're trying to tax all foreign income now. And they did that through the elimination of the 10% of QBI in calculating your GILTI and the 10% of QBI in calculating your FDII income there. They repealed that. And by doing that, it took away the focus of TCJA, the focus being in excess profits and tangible income, and just saying, no, we're not looking at that anymore. We're looking at just foreign income in general. And we want to tax that foreign income in general, not just intangible income or excess profits. One thing I will just kind of mention is I'm curious to see if any U.S. multinationals are going to start lobbying Congress here saying eliminating the 10% of QBI in calculating FDII makes sense. However, you should have retained the 10% of QBI for GILTI. They are not the same thing. And the reason is expensing. The domestic tax base, most of your costs are now expensed. But your foreign tax base, you have to use the alternative depreciation system, which is straight line depreciation. Your foreign R&D can't be expensed. It's capitalized and amortized over 15 years. It's not the same thing. And so I'm curious to see if the U.S. multinationals will come in and lobby Congress saying, restore the 10% of QBI for GILTI, but you did the right thing in repealing 10% of QBI for FDII.
And Christopher, I think the quick takeaway for our companies with multinational, again, Canada, Mexico, kind of anywhere else is, it's worth revisiting kind of the work you've done around Pillar 2, your GILTI calculation, all of that, because there are going to be some things that maybe you assumed were going to happen that are in fact not going to happen now. And it's worth a fresh look at that if you had been going down a certain path before. Dave, do you want to cover a few financial reporting hot topics on the tax side before we kind of run out of time on our webinar today?
Right. Sticking on the theme of OB3, as we have been discussing, July 4th is the key date of enactment. And so under ASC 140, we look to the enactment date for when we book the tax effects of newly enacted legislation. As we've been saying, there isn't a change currently to the 21% rate. So normally when you have tax law changes, you see rate changes, and that's really a big part of the effect of the rate change. We're not seeing with this enactment much in terms of permanent adjustments to the rate. But one thing to be considering right now, as you're in the beginning still of the third quarter, is begin considering if you have a valuation allowance, what does the new tax law mean to the future? There's a lot of, as Andy mentioned, there's a lot of new deferreds, in terms of expensing that are going to create DTLs. We're going to have more potentially situations where companies build NOLs with the bonus depreciation deductions. But then we're going to have some lower DTAs because we won't be capitalizing 174. And with the expanded add backs for depreciation and amortization, we maybe are going to be able to deduct more of our interest expense currently. So there'll be less DTAs there. And so it really deserves a revisit to your valuation analysis and your projections to determine either upon enactment or in future periods as you monitor that, might you have a change in your valuation allowance. So just wanted to bring that to everyone's thinking to start that process. So we need to watch for whenever we have a tax law change, upcoming changes for technical corrections. We see this all the time with TCJA. There were a number of technical corrections, and those will all have their separate enactment dates. So as each one comes through and you analyze the impacts, those would be reflected in the period of enactment. Christopher mentioned the international changes. So those you're going to be looking at beginning next year when those changes come into effect for tax years beginning after December 31st, 25. And there you could get some changes to the effective rate, with changes in the rates for GILTI and BEAT and the change to the FIDI structure where there could be some rate effects. We mentioned ASU 2309, which is effective this year for companies, public companies, periods beginning after December 15th, 2024, that expands the required footnote disclosures from a federal viewpoint. One of the 8 specific disclosures that is required is the effect on changes in tax laws or rates enacted in the current period. So in the annual financial statement for this year, with the adoption of 2309, most companies will have something to put on that line, potentially. And that line covers not only the current tax effects, it also covers the changes related to deferred taxes. We've been talking about deferred taxes and liabilities. And so that would also go on that line as you evaluate with your DTAs and DTLs those effects. One other item I wanted to mention here, if you've been booking R&D credits for the first half of this year, that's a permanent rate benefit. And with the capitalization of Section 174 that we had previously, there wasn't, in all cases, a requirement to add back the credit as a reduction in your 174 cost. Now, with the expensing of 174, something to take a look at, more companies may go to the reduced credit option to avoid that add back. So that could cause some reduction in your R&D credits that have already been booked for the year. That potentially would be a rate effect item in your Q3. So watch out for that one, as well as the valuation allowance considerations. We've been mentioning ASU 2309. We did have a webcast on July 31st. Please click on that when you have a chance and view the webcast, because there's a lot of helpful information as you begin to apply that ASU to your situation this year. Thank you.
Thank you, Dave. Appreciate you, Christopher, Andy, and Porter giving us kind of an update. We did link here, like you mentioned, to that webcast on 2023-09. In addition, the Baker Tilly website has a lot of information about the new tax law and some additional insights, for a variety of organizations, individuals, et cetera, as well. So please do see our website for some additional information. Unless there's any final comments, I think I'll turn it back over to Emily to close out the webcast.
All right. Thank you, John, Porter, Dave, Andrew, and Christopher for a great presentation today. If you submitted questions for our presenters, we ran out of time and we'll be following up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.
Thank you.